Warren Buffett posted his 2021 annual letter this weekend, and there's always a lot to learn about investing in Berkshire Hathaway. One thing that surprises, I think, a lot of folks is the reality that outside of Berkshire Hathaway stock buybacks, Warren Buffett has been a net seller of U.S. stocks, of stocks in general, for the last 3 years. We'll talk about that aspect and more in this video. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, this is not financial advice, and at the time of this video publication, I did not own stock in Berkshire Hathaway. And so one of the key aspects that I love about the Berkshire Hathaway letters is the wisdom that Warren Buffett passes on. I think this is helpful to understand what is the investment game. Here's a direct quote from Warren Buffett where he goes, "Whatever our form of ownership, our goal is to have meaningful investments in businesses with both durable economic advantages and a first-class CEO. Please note particularly that we own stocks based upon our expectations about their long-term business performance and not because we view them as vehicles for timely market moves." That point is crucial. Charlie and I are not stock pickers. We are business pickers, and I think there's a lot to learn from that aspect. And this approach of focusing on the underlying business versus the wiggles of the stock price has resulted in them compounding at over 20% annualized since 1964, resulting in a 3.6 million percent return, or 120 times better than the S&P 500 during that same time period. And they've grown doing this approach, this business-oriented, business-focused approach versus stock price-focused approach. This approach has resulted in them just growing to huge size. They've grown into enormous size. Berkshire Hathaway paid $3.3 billion in corporate taxes in 2021, which is nearly 1% of all U.S. Treasury corporate taxes in the United States. Berkshire also holds over $120 billion in U.S. Treasury bills, which represents nearly 0.5% of the publicly held national debt. So not only are they a large taxpayer, but they also hold a large amount of U.S. publicly traded debt. And so how is Warren Buffett investing these huge cash flows, this huge cash coffer? He has 4 choices. The first option is reinvesting in their owned businesses. A lot of folks don't realize that Berkshire Hathaway owns more infrastructure as classified by property, plant, and equipment than any other American corporation. So pretty much by all means, Berkshire Hathaway is an infrastructure company. Berkshire also owns BNSF, or Burlington Northern Santa Fe, which is the #1 artery for American commerce, shipping 535 million tons of cargo across 143 million miles. Think about that. That's just so incredible. And Berkshire has been spending at least $13 billion a year on property and equipment for each of the last 3 years. 2 years ago, it was nearly $16 billion, but that's still not enough to suck up their nearly $40 billion in annual operating cash flow. And so Warren Buffett's second option is buying pieces of businesses or stocks in the public market. His largest bets currently include Apple, American Express, Bank of America, Coca-Cola, and Kraft Heinz. You can see how some of these have significantly appreciated over time. Apple, something like 5x. You look at something like American Express, it's gone from a $1.3 billion cost basis to nearly $25 billion market value. And Warren Buffett's third option is to buy the entire business. So he goes, I like the stock price so much, why don't I try to buy the whole thing if regulators allow me to? But the reality is that when you look at the data, over the last 3 years, there's been a real drought of activity with only a few $1 billion in acquisitions. You can see only $456 million in acquisitions last year, 2.5 the year before, 1.7 the year before that. But overall, that's for buying entire businesses. When you look at his transactions with individual stocks, the reality is he's been a net seller of stocks these last 3 years. So despite generating nearly $40 billion in operating cash flow each year, they've been effectively saying, hey, the bargains overall aren't that compelling with the markets. We are selling, net sellers of our positions. You might see individual positions that he buys, but overall net seller of stocks. You can see in 2021 sold $16 billion worth of stock versus buying $8.5 billion. The prior year, 2020, 38.8 billion worth of equity sales versus 30 billion of purchases. Now, this does exclude buybacks, which we'll talk about in a second. So why is he selling so much stock, arguably, or why has he been a net seller over the last few years? It's about, I believe, about $11 billion worth of sales net over the last few years. And so the reason why is that he says, today, though, we find little that excites us. That's largely because of a truism. Long-term interest rates that are low push the prices of all productive investments upward, whether these are stocks, apartments, farms, oil wells, whatever. Other factors influence valuations as well, but interest rates will always be important. He's right here. There's a little bit of a different perspective as well, given the fact that you can look at other countries that have very low interest rates and have much lower valuations. So it's not always that you will have, low interest rates driving high valuations. You can find countries with low valuations and low interest rates. So that other factors that he's talking about, I believe, is sentiment and sort of the raw spirits, animal spirits of buying up stocks. So looking at U.S. equities in particular, and that's really what he's focused on historically. He's saying, look, I'm not really that excited. Things aren't that cheap for him, given that he has to manage, a business that's bringing in $40 billion in operating cash flow a year. So what is Berkshire Hathaway doing with their cash flows? And the answer is they're doing buybacks. Nom, 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 nom. Where in the last 2 years, Buffett has bought over $50 billion in Berkshire Hathaway stock, or roughly 9% of the company. So this is a call that in the last 2 years, he's effectively said, hey, I like the valuation. The underlying business does seem like it trades at a reasonable valuation. If you want me to do a whole separate other video talking about Berkshire Hathaway's valuation, let me know in the comments below, or hit that thumbs up. And so look, retiring 9% of the company in the last 2 years, or about 4.5%, 5% a year, that is a nice tailwind to shareholders. But the reality is that year-to-date 2022 through nearly the end of February, Berkshire has repurchased only $1.2 billion in stock. This implies an annual rate of, let's say, $7 to $8 billion in buybacks for 2022 versus the $27 billion in 2021. This means the current prices are still appealing, but less so than the lower prices in 2021. And this makes sense. Berkshire stock is up nearly 30% in the last year. So Buffett's saying, wait a second, has my business fundamentally grown 30% this last year? No. And so what he's saying is that, yes, book value did increase nearly 30%, but I'd argue the fundamental earning power of Berkshire has not. A large chunk of that change in book value was due to, changes in their marketable securities. And so he's looking at this and saying the valuation is not as compelling as it was a year ago. And it's also possible that in lieu of buybacks, he's also starting to look at buying stocks again, as the major U.S. indices are down about 10% so far this year. So maybe he's finding more to do. We'll see. So what are some of the key musings, key learnings we can consider from Buffett's annual update, as we look at this? And so I have a couple of thoughts here. The first is, here it is, Buffett's bringing in $40 billion a year in terms of cash flow to Berkshire Hathaway. And I think the lesson there, number one, is be disciplined. And so he's saying, look, he's a net seller. Arguably, he doesn't spell it out like that because he doesn't want to say he's selling America or anything like that. He's still saying buy America long term. He's looking for assets that he can own for 100 years. He calls out Burlington Northern as a company that he thinks will still be valuable to Berkshire and America 100 years from now. So that's his time frame. But I think the number one lesson is that even though you might get periods where everything gets bid up and other people find value in, let's say, higher prices, stick to your own game and play the game that's right for you. And so he's being disciplined for himself. He's keeping arguably a high absolute hurdle where he's saying, hey, I need to see maybe an 8, 10, 12% minimum annualized return when I'm buying something. And so that means finding companies that trade at low multiples to free cash flow. Maybe it's a company trading at 15 times cash flow or under that. And so that first lesson, I'd argue, is be disciplined. Here it is, Warren Buffett. He's saying, look, with higher interest rates, higher valuations due to sentiment, I'd argue, he's finding less to do. The other key aspect to consider is that part of the key reason that Warren Buffett and Charlie Munger have done so well with Berkshire Hathaway over time is that they have been focused on being business pickers versus stock pickers. You see a lot of volatility in stock prices. That's really not what he's judging here. What he's judging is what is the underlying business fundamentals doing over a multi-year period. So if you find you have a stock that goes down all of a sudden, you're down 30%, or you find you have a stock that goes up 30% in just a couple months, don't get overly excited or don't get overly disappointed. What you need to focus on, at least if you're going to try to have a journey like Warren Buffett, is you need to focus on being a business picker. What's the business doing over time? Track how that's doing. Track the quarterly updates. And I'd argue, consider writing it out before you make the investment. What are the key aspects that you're going to be following? Is it revenue growth? Is it new customers? Is it profitability? Tracking key metrics to judge a business. And I think the third key aspect that's always worth considering with Warren Buffett as just an incredible reminder is, I mentioned a minute ago how he made a bet in this annual letter talking about how he thinks Burlington Northern will still be valuable, in a century from now, which is really just incredible to think about because he's, over the next century, you're probably going to see autonomous trucks. You're probably going to see electric trucks. I'm not sure how that will play out and compete with a massive rail system. And so that is a question. I'm super curious to watch how that plays out. That said, Burlington Northern continues to grow nearly $8 billion in profitability from that segment. And so looking at it, the key lesson here is think in long duration growth. He's saying, I'm thinking this asset will still be valuable 100 years from now. Now, I don't have conviction on anything 100 years from now, but I think it is worthwhile when a lot of people are thinking in days, weeks, or months to consider, okay, what's this look like in 10 years from now? And looking for things that you think can be growing at a good clip is a durable business for years and years to come. So that once again, that reinforcement of if you're going to be a business picker, if that's the type of journey you want to have, you want to be focusing on businesses that you think are durable, that you think have this long-term growth advantage that should result in ideally attractive growth for shareholders over time. I hope this video updating Berkshire Hathaway's 2021, calling out their results or calling out their latest lessons and what Warren Buffett has been doing has been helpful for you. Please make a point of hitting that thumbs up and hit that subscribe button. Thanks so much for tuning in.